And joining me now to talk more about the markets is Sean O'Hara. He's a president of Pacer ETFs. Sean, thanks so much for joining. A lot to digest this morning. Let's start with tariffs, of course, because that is moving markets amid a busy week of other themes like earnings and jobs, too. What's your reaction as we begin this Monday morning?
Well, I mean, I don't think it was a surprise that the president was going to do what he did. However, I don't think the market's necessarily reacting very favorably to it. It perhaps is a little bit too early to, sort of see what the end effect is going to be. I think anybody who has followed him over the course of his past, in the time he was president, who knows that this is sort of how he operates. And he did the same thing last time and everything worked out fine. I think, we'll have to wait and see here how long this takes and whether or not we can actually get to some common ground that's a little bit more common sense or agreeable to everybody. So I think that's a big part of the story with regard to what's driving the markets down today. I also think that, you need to keep an eye on the fact that the markets have been somewhat stretched as far as valuations. And so this may be just be an opportunity that, it's coincidental to the tariff announcement, where people are just sort of taking a little bit of profits or rebalancing portfolios, try to reduce their risk a little bit.
I do want to talk about earnings, Sean, because that, of course, is a key fundamental that does move the market over time. And we've seen a good amount of companies report, the vast majority of them exceeding earnings expectations, not as many exceeding revenue estimates. What is your takeaway from this reporting season so far?
I think it's been sort of in line. I think we've expected to see earnings grow somewhere from around 10 to 12%. It's been sort of a mixed bag, if you will. There have been some winners and some losers. I think that the story going forward is, can we sustain these numbers with regard to earnings growth? And I think some of the things that are on the agenda for this administration, if they can get them done quickly, will be a good sign for the markets going forward. If we can get, some reduced regulation, for example, or if we can get corporate tax cuts. All those things are good for the bottom line of companies. And so that may help sort of the E part of the PE equation that we talk about so often catch up. The last couple of years, we've seen a pretty significant expansion in multiples. And so, those things don't tend to last forever. They only last until people believe that the earnings growth is not going to be there. And I think we're still a little bit early as far as whether or not we can come to any real solid judgment there.
Well, the jobs report is on tap, released the first Friday of every month. Of course, the jobs report that we'll get on Friday does cover the month of January. How does the jobs market look to you, Sean?
I still think there's more job openings than there are people. So in that regard, I think it looks pretty good. I think, the unemployment number is relatively low. I think, the Fed watches that in addition to inflation. And so I think they'll keep a very, very tight eye on the jobs market. I think we'll come in sort of in line with where everybody's expectations are. I don't expect to see any big collapse, if you will, in jobs or any real huge surprise to the upside.
Now, when it comes to capital flows, of course, with Pacer ETFs, you would have a good sense as to how the dynamics are changing in real time, Sean. What can you tell us about that?
Well, I think the big story is it's all U.S., and particularly large cap U.S. I think that's been the dominant flow trend for a while, and it's continued into this year. We're certainly seeing that on our side of the equation, whether it's into large cap value or large cap growth. We do take a little bit different, have a different take on both of those things and how to construct portfolios using free cash flow on the value side, free cash flow yield, and on the growth side, free cash flow margin. And we've had some nice flows. We've started to see a little bit of a leaning towards some of the risk mitigation strategies that we have. I think, as people start to see this market get a little bit stretched, or we've gone, up to plus 22 years in a row. I think folks are looking at ways to perhaps, lock in or protect some of the profits that they make. So there's been a little bit of a change there as well.
I do want to talk more about diversification because we've heard people say that it might be a stock picker's market. What do you see when it comes to diversification and active versus passive investing, Sean?
Well, I'll give you a great example, Kristen. We have a large cap growth fund, COWG. It uses free cash flow margin as its screen. And it has competed very well with the NASDAQ 100 and the Russell 1000 growth, actually producing better returns. But when you look at it, it only has about 17% overlap to those big broad indexes, and it only has 4% of its weight in the Mag 7 names. And so I think that's the diversification story that needs to be told, is that, we are in a position now where we're probably as less diversified in these broad indexes than we've been in quite some time. And that's been great. Everybody's been celebrating it on the upside, but however, if things reverse themselves, it could be just as disastrous, if you will, on the downside. And so, one of the things we're focused on is trying to help financial advisors diversify their growth holdings by using a slightly different approach and not having that over concentration and that big overlap to everybody else's growth fund.
When it comes to the Trump administration, Sean, those tariffs were announced on Saturday, over the weekend, in the markets responding this morning based on the data inputs. What is the next thing that you feel like the investing community may hear from the White House?
Well, they're obviously pushing on corporate taxes, which is good for stocks. I think the next thing we'll probably hear is that this sort of a mini trade war is going to get itself resolved here fairly quickly. I don't think that Canada and Mexico can really put up a huge fight. I think they can posture a little bit, which they should, right? But at the end of the day, I think we'll wind up with a resolution here that that all three countries can deal with. Then I'd be looking for some of the things that would help profitability, like regulatory change. Try to get some of the red tape and the bureaucracy out of the way of some of these big companies and all companies for that matter going forward. I think that's also going to be a big driver for future growth.
Sean O'Hara, president of Pacer ETFs. Sean, thank you so much.
Thank you so much. Good to be with you.